Good afternoon, everyone, and welcome to our quick update webinar. We don't usually do kind of mid-quarters updates, but like I said in the letter that I sent you yesterday, these are different times, they're unusual times, and in accordance with our partnership principle number 1, we felt that we owe it to you to give you this opportunity to interact with us kind of before the end of the quarter, share our thoughts, answer your questions. So the letter that we sent you yesterday, we also mentioned the special nav, which Mark can address later on in the call. In terms of the format, I think the way we're going to do that is the following. So this being webinar format on Zoom, the default is for the panelists. So Aubrey, Mark, and I will be able to talk. Let me see. Sorry, we've got our first question. It looks like someone's asking about my mug, and this is, if you can see it, it's R2-D2 from Star Wars. We will have a Q&A session in the end, so you can also ask about anything else like that later on. But thank you for the question. You're all now in a mode where you're allowed to talk. If you have trouble, just send me a chat, which you can access at the bottom of the screen. But you're all on mute now, so you'll have to unmute yourself. If in order to keep this as short as possible, maybe the three of us can talk a little bit, tell you briefly our thoughts, and then we'll jump into Q&A. And I think you'll be able to raise your hand and ask a question. Either way, you can unmute yourself. Once you've asked your question, please do mute yourself after that, just to help with audio interference, because we've got 28 people so far. I see a couple more that should join soon. Right, so I'm just going to go through some of the remarks that I prepared. And the first thing that I want to say is, joking aside, we do need to remember that we are in a situation that is, while not unprecedented, it's very rare that the size of the pandemic is pretty big, and the consequences and human cost of this is potentially also very big. So before we start talking about markets and investing, I do want to remind myself to contain my enthusiasm and excitement. And remember that there is an element of human tragedy in what's happening. Our lives are being lost, lives are being disrupted, and we need to remember that. And I hope that all of you are following proper advice, staying safe, washing your hands, all of that. And I have faith that we're going to get through it. And it seems that the right approach is to try to spread it over time. So instead of having a very painful short impact, it seems that almost all governments in the world have made a decision, and it's probably the right decision, to try to spread it out to help health services and societies kind of deal with this in a way that is doable without too much human cost. And unfortunately, for better or for worse, that is the reason why there is an economic cost to this as well. So it's not necessarily the virus itself that's causing kind of the economic issues, but it's the efforts to kind of contain and manage this virus that is causing all this economic costs and the market disruptions that we've seen so far. So with that being said, I want to first start by touching on something that I mentioned in the letter yesterday around business continuity. Part of our job has always been to try to think about kind of worst case scenarios, not in the businesses that we invest, but in our businesses as well. And as a regulated firm, we have to have business continuity plans on hand that we've tested and tried over time. And this is the time where this sort of thing comes in handy. As soon as the virus started spreading, we retested our systems and made sure everyone can work from home. As you can see, I'm now working from home as well. We started by giving everyone the option to work from home about 2 weeks ago. One of the first things that we did actually is that Aubrey was the first one to start working from home. And part of that is that from a business continuity point of view, it's very essential that both Aubrey and I don't get sick at the same time. And so we took the goal of basically separating senior management into 2 different places of work. I personally, because I don't use public transport to commute, have continued to go to the office until government guidance came out day before yesterday and asked all companies to work from home. So I've started working from home yesterday. We use Microsoft Office 365 suite of services, specifically Microsoft Team, to collaborate. Because we've always had a flexible work environment, many of us have worked from home or remotely several times over the year, or over the years, I mean. So this is not new to us. We all had the equipment in place to be able to deal with that. And so that enabled us basically not to have to go. A lot of businesses, unfortunately, have had to go and figure out new ways where they could work together. And we haven't had to do that because the plans are already in place. So now let's talk a little bit about economics. I'm not an economist, so there's not a lot that I can add in terms of understanding what's going on above and beyond what all of you have probably read. I can maybe just tell you a little bit about kind of the way we see things evolving and probably kind of the longer term, the shorter term and longer term impact on that. After that, I'm going to hand it over to Mark, who I think has a few questions that have been sent beforehand. Some of them are addressed to me, and I think some of them were addressed to Aubrey. And then also allow Aubrey to say a few words, and then we'll go into Q&A. So I think in the beginning of this, when it all started in China, specifically, it was a supply shock that everyone was worried about. So with China being such a big manufacturing hub for a lot of companies in the world, and a lot of actually basic materials that go into things that eventually through value add get assembled elsewhere, there was a massive supply shock, and that's what we saw kind of the beginning of this quarter into February. And I think it seems that China has reached a place where things are recovering there, both economically and health-wise. And I think we're now, with the virus spreading to other economies, especially Western Europe, United States, we're entering the second phase where there's basically a demand shock. And I stole this kind of two-phase thing from Abdullah Zaman, who we had a chat about a couple of days ago, and I see is on the list of attendees. So just list of attendees. So generally give credit where credit is due. And then in this phase, the problem is that it's the efforts to contain the virus that are having the widest impact and probably the longest impact on a lot of businesses. And in places like United States and Western Europe, where the service sector is a big part of GDP and consumer spending is a big part of GDP, you're going to see what's happening now, which is a more profound impact on the economy and a much bigger drop in GDP, even if it's in a very short period of time. Now, the thing about demand shocks is that they're different in the sense that some of the demand can be, there's a catch up in it where, for example, if you were planning to go on holiday in May and all flights will cancel, and then this thing is gone a couple of months after that, you can go back and buy that vacation. And so there's a catch up there. You were planning to have one vacation a year, you're still having one vacation a year. But other kinds of demand, there is no way for it to catch up. If you don't go to eat out tonight, you're not going to go and eat out twice the second Thursday in August to make up for it. And so businesses are going to have to deal with this differently, and the impact on it is also going to be different. So one is essentially a shift in demand, either partially or fully. And in some cases, no, it's actually demand disappearing. That kind of volume of business is never going to come back. And that's very critical in the way Aubrey and I think about how businesses are going to be impacted by this. The other thing that I want to say is that even though there's a short-term nature to this impact, there could be long-term implications to something like this. And the reason there are long-term implications is probably one of two, or at least broadly two big buckets. The first bucket is if there's a change in the business or the behavior of the customer. So there's a change in supply or a change in demand that's ongoing in nature. And one example of that is that, I mean, I've been shocked by the volume of hand soap that is being bought in supermarkets, at least where I stay in the UK, because I thought everyone was washing their hands. And it turns out they haven't been. So I hope that after this incident, people, the propensity to spend on hand soap may not be as high as it is now, so it may still come down, but I think it'll probably come down to a level that is higher than what it used to be. So this is something where you could expect a shift in demand upward and on an ongoing basis, at least for a while, could be for years. And in other cases, maybe the other way around. So there may be things that we are doing now on the demand and supply that we may do less of in the future, because we start to freak out about small spaces or sickness or things like that. I suspect there's more of the former than the latter on an ongoing basis, but that's just a guess. On the supply side, on the other hand, I do see there are two things that happened this year or over the past, let's say, 12 months that I think kind of put things in perspective, which is the fragility of the way companies run their supply chains. So one lesson that companies have learned the hard way the first time with things like the China trade war is that they were too dependent on a small number of suppliers from one country. And while there's no manufacturing capacity outside China to absorb that business right now, if we're thinking about it in a 1, 2, 3, 5 year time horizon, that could change. And so I suspect that we see more of a diversification away from China in terms of the manufacturing base, even if it's other places nearby China. But I do suspect that you're going to see more of that because you got hit by the trade war and then you got hit again by this. And the other lesson that we get out of this is just-in-time inventory may be too risky for a lot of businesses. And this idea that you can drop ship things from a manufacturer in China straight to your customer, you may change your behavior going forward and hold more inventory closer to your customers, or you may even start to manufacture closer to your customers. I think the former is more likely than the latter because of the way manufacturing works and the capacity to have manufacturing facilities where customers are, but some of it might also happen. So those are the things that we have to take into account in terms of the behavioral shift. The other thing that we have to take into account, which you could argue is a valuation exercise, is even if we identify a restaurant down the street, for example, that we think will have the same volume of business in 2023 that they had in 2019, and the same profit margins and the same number of customers walking through the door. The relevant question then is the relevant two questions. A is, are they going to make it to 2023? So there is a question of resilience. Can this business, do they have the balance sheet? Do they have the ability to actually get to that point? And then the other thing, what is the cost to get from here to there? So for example, we've seen that governments have come out, and this is just the beginning of it. The response has been huge. But they've come out with interest-free loans, unlimited loan guarantees, unlimited loans in some cases, and that may enable that restaurant down to the street to survive. So that restaurant down the street, this government intervention may allow it to stay afloat for a next extra year, and then make it to 2023. However, during this year, it would have accumulated an amount of debt equal to whatever amount it's been losing during this period. And that amount of debt, even if it was interest-free, would still need to be paid back. And so that's an amount that you have to deduct out of kind of the enterprise value and your valuation for how much you would pay if the business owner offered to sell you that restaurant. So those are the two things that you have to think about: resilience of the balance sheet, and then the impact on valuation from this extra debt if the balance sheet allows for that extra debt. Now, the other thing that I wanted to touch on is whether we expect a recession. Now, technically speaking, a recession is defined as 2 consecutive quarters of negative GDP growth. And I think when we look at the definition itself, it actually makes answering the question more difficult. And the reason is, there is a chance, I'm not saying it's the likely chance, but there is a chance that, Q1 is most likely to be positive still, just because the impact is backdated in most places in terms of GDP growth. And you could have a really bad Q2 GDP rate. But then if things recover in the third quarter of this year, technically it may not be a recession. However, I've got a comment from one of our smart investors saying that the National Bureau of Economic Research says this is not the actual definition. And yes, you are absolutely right, Demetrius. There is no technical definition. The NBR decides what a recession is, but let's just go with that. The point is, which is what I was making actually, is that if you have a minus 15% growth in Q2, that is much worse for businesses and the economy than -1 and -1 in Q1 and Q2. So the cumulative effect and the hit to the economy and to jobs is not just the issue of how long a decline in economic activity goes on, but also how deep it gets. Because businesses are going to react to how deep it gets. And so when you see companies like some of the airlines laying off 40, 50, 90% of their employees or furloughing them at least for a temporary basis, that's a massive impact. So the question of whether we have a recession technically or not, I don't think it's relevant. We might as well call it one. The real question is what happens after that? How does the recovery out of this look like? And again, I'm going to use, for the economists in the group, I'm going to use language that I understand that may not be economically technically correct. But is this economic activity going to take a V shape, a U shape, or an L shape? Is one way to look at it. And in this sense, again, back to that example, and nobody, by the way, knows what this GDP rate is going to be on this quarter. I just used minus 15% as an example. It could be worse. It could be better, it could be worse. Really, nobody knows. It's too early to tell. But the point is, we could have minus 15 in Q2 and plus 15 in Q3. And that would be a V-shaped recovery, or plus 15 in Q4, it doesn't matter. A U-shaped one would take time until it recovers. And an L-shaped one means that you actually enter in a prolonged recession. It takes a very long time to recover out of that. And the way businesses react and the way we answer the question of the resilience of the balance sheet and the funding requirement and its impact on valuation is going to depend on how we think such a recovery would happen. Now, timing aside, because it's going to be very hard to kind of, I personally think it's impossible to guess the timing of these things. I do think that history tells us that it's more likely to be a very sharp decline, followed with some lag with a very sharp recovery. However, like I said, it's very hard to guess these things. And the reason I think that's the most likely scenario depends on two things. One is the evidence that that we have so far, judging by similar incidents in the past. There aren't many of them, but there are some. Is that this sort of recession, coming into it with the type of economy that we did going into it, which is fairly strong, and it not being caused by a credit issue like what happened in the Great Financial Crisis, leads to a faster recovery than otherwise. Now, a lot of this is going to depend on how governments react, and that's what's informing some of my view, at least, which is in previous cases when we've had a shock to the economy that is massive, the governments have reacted much slower and much sooner than they already have. So it seems that they're going with a very extreme, to use Henry Paulson's metaphor, they're coming with a bazooka and doing it very early on. Now, this is an evolving view, and as you can see from the headlines, these things change very quickly. But so far, it seems that governments are erring on the side of overstimulating as opposed to understimulating, which was not the case in the beginning of the Great Financial Crisis. So they're reacting with more force and faster force. And that gives me optimism in the latter part of that recovery. What this says nothing about is how long it takes. And the reason the actions of government is irrelevant to how long it takes, I think, is I can give you all the cash in the world. You're still not going to go out and have dinner out tonight. That is a function of how quickly the virus can be contained. You're also not going to go and travel. You're also not going to go shopping at the mall. So these things are tied to an essentially a biological event that we still don't know how long will take. And so government intervention can help businesses survive this period, and they can help accelerate the recovery from it. But the financial intervention by governments cannot change how long it takes. That's going to depend a lot on what happens on the health front. The one exception to this is that if it does get a lot worse, you could have more layoffs and you could have a further deterioration of the financial situation in the economy, in which case there's a mechanism where a worse health outcome can also lead to a prolonged financial outcome after the virus period is resolved. So those are the two things, and maybe Dimitris can step in a little bit later and add some of his thoughts on that. Now the question is, what do we do from a portfolio management point of view about this? Now, the good news is, because of our valuation discipline, we've entered this period, so basically in February, with an almost all-time high cash balance. We were briefly above 20%, but we entered this period at about 19 and something percent of cash. We've also entered with a very big allocation to the conservative side of the types of things that we own. And that has helped us so far in kind of mitigating the impact of the decline. The other thing that helps us, which we've talked about in the past, is if you go into a situation like this with a lot of cash and a conservative portfolio, it gives you the opportunity to take advantage of opportunities as they present themselves. And now, looking at the market right now, there's been obviously a massive sell-off. I turned off my Bloomberg before we started this call, but we are looking at 30+ declines from highs. But the sell-off has not been across the board. So on the one hand, in situations like these, you'll often have kind of the throwing the baby with the bathwater situations where everything gets sold off. And some of that did obviously happen. But on the other hand, some sectors have been hit a lot stronger than others. And one of the points that actually I was surprised about is there's been a massive revaluation over the past 5 years or so in dividend paying stocks, as they've become, in a sense, bond proxies. So as interest rates have gone down on fixed income, a lot of people have gone and bought consumer staples specifically, and utilities and so forth, in order to capture that dividend yield instead of fixed income. And those things haven't come down as much as others. And that's partially driven by the steep decline, I suspect, in interest rates over the past couple of weeks. And so people have sold them off, but they didn't sell them off as much because now you've taken rates down to essentially zero. And if anyone wants any kind of income, they're kind of stuck with that. The flip side of that is that when you see an index going down by 25 to 30%, it means there are a lot of things in the index that have actually come down on 40, 50%. And so, the other thing that I think happened is a lot of names were expensive, and at the beginning of this year, while other names were around fair value at the beginning of this year. And there is a little bit of massive sell-off across the board. So some of the things that were on our wish list that used to be around fair value are now 30% or more below fair value, while there are other things that were on our wish list that were 20% overvalued are now pretty much fairly valued. So not everything is cheap, and I wouldn't just go and buy indiscriminately. Now, what have we actually done? So like I said, I mentioned we entered this period about 19% cash in the fund, and we've been looking through our wish list. We've updated a lot of the valuations to take into account the risks that I talked about in terms of the resilience and the impact of having to finance that gap where business is low or non-existent. And there are many businesses that look different under that lens, which necessitates that we do that. But once we have done that, we have found that a lot of the names that were on our wish list, and maybe Aubrey can touch on that a little bit more later, are now at levels that tell us two things. One, as long as we're fairly certain that the business can survive, and notice that I said the business and not the company. And two, as long as the company can survive, in the sense that will the equity holders still own the company in the same percentages that they own it today. And the reason that's key, I think, is you can think of, again, I'm going to go back to that restaurant down the street example. Let's say Joe owns 100% of this business and the restaurant has no debt on its balance sheet. During this year or the coming few months, Joe ends up building up about 500,000 pounds of debt. Business recovers, and next year the restaurant is selling as much as it did the previous year, but Joe still has to pay that 500,000 back. Now he has one of two options. He can go and start paying off that debt incrementally from earnings. But if his annual earnings are 100K or 150K, it'll take him too long to do that. And if he needs to live off of those cash flows, he won't be able to. And so that leads him to have to sell equity in the restaurant to reduce that amount of debt, in which case he goes and he brings in an outside partner. The outside partner puts out 500,000 to pay off the debt. The restaurant and the company become debt free, but now it's co-owned between Joe and this new financier. And we have to think about our companies in the same way. So when we're doing a valuation exercise, yes, the business may still be worth X 2 years from now, 3, 5 years from now, but we also have to remember the dilution, essentially, either in the form of debt or in the form of equity that will happen. And equity is basically explicit dilution. Debt is implicit dilution in the sense that instead of paying dividends to the shareholders, you have to pay it to the bank or someone else who gave you that financing. Now, that being said, we still found a lot of opportunities, and our cash position has gone down from about 19% in February to about, I think today, I mean, there are a few things that we've been buying essentially almost every day, but basically we're down to about 8.5 or 9% cash, 8.5 and 9% cash position as of today. And there are many names on our wish list that we would start buying if they decline another 5, 10, 15%. And so with the markets being as volatile as they are, the odds are within a week, 2 or 3, we may be fully invested as a fund. Let's see if I wanted to say anything else. Yeah, the final thing I wanted to say, which I touched on the letter, is that we are not calling a bottom here. I don't think anyone can tell you that this is the low. However, I don't think the question is even relevant because I don't think it's doable. And the relevant question is, if I buy today and I close my eyes and I open my eyes 5 years from now, what would have happened? Am I gonna get a return that is satisfactory relative to the risk and discomfort that I'm going through today? And in many places in the market today, the answer is actually no. There are many things that I don't think are so attractive that I'd want to buy and stay on for 5 years. However, there is a handful of names, or there are a handful of names that we are looking at, some of which we've already bought and some of which we are actively buying. The nature of the volatility means that we are buying into them incrementally. So we're buying a little bit every day instead of going all in. And I have a lot of confidence that those things, when we wake up 5 years from now, we're going to look back and say that was a great opportunity to buy them. However, I also believe that this is going to be a very bumpy ride. And as you've seen the past couple of weeks, there have been consecutive days of plus or minus 9 or 10% in the market. And some of the names that we own have had big 20, plus or minus 20% swings. There is one name that we own that had a low to high swing in one of the past few days of almost 38%. This is within a day, a low to high range of 38%. So the level of volatility is pretty unprecedented. And that means that this is going to be a bumpy ride, but I think in the things that we own, at least in the things that we're looking at, I think it's going to be worth it. So that's what I wanted to say. I want to now hand it over to Aubrey to say a couple of words on some of the things that he's looking at. And then after that to Mark, so that he can talk a little bit about the special NAV, and then we'll open it up to Q&A. Aubrey?
Okay, can you hear me?
Yes, I'm gonna mute myself just while Aubrey talks.
Okay, so, obviously, as Aziz has said, a huge number of ideas we've been looking at for quite some time, have all of a sudden become available to us. And, so for a lot of these, it's actually been quite easy. There are companies that we've looked at for, months, sometimes years that we've been waiting for. There's one, I'm sorry, I've got a screen here that is flashing and telling me that one of the companies that we've been hoping to buy for, since 2016, maybe, mid-2016, is finally getting into a price range that we can buy it.
I know the name, don't say it.
I won't. But you know, so what that means for us is the level of analysis I need to do is very little. It's already been done 3 years ago, and it's been monitored over the last 3 years. All that we need to do now is just double check: is the price okay? Has anything happened that is going to change? And obviously, with this one, there has been a big change, and that is COVID. We cannot deny that there is a huge change there. So we have to stress test it, and we go through that. And as he said, we have to look at the debt. Is the company and is the business going to survive for the next 1-2 years? And it is going to be difficult, but we'll look at things like the debt distribution. So we'll look at when is the debt due to be redeemed? For a lot of businesses, they don't need to repay their debt, repay the capital for several years. And in which case, in many cases, that's going to be fine. But if you are having to repay a huge amount of debt this year, then you could be in a huge amount of trouble. So we're going through all our holdings, checking, is this an issue? Are we going to have to repay a huge amount of debt that we can't afford this year? And fortunately, we haven't found anything in our portfolio that gives us cause for concern, and nothing in our wish list yet. So that's certainly one thing, but also there are other things that we haven't particularly worked on a huge amount that have come up because they are, because the price has moved a huge amount. And other things. So, Aziz, are we going to mention names here, specific names here? Or shall we, given that we are buying?
I don't think we should mention names that we're buying. I don't think, looking at the list now, we've got 38 people on. I don't think it's going to make a huge difference, but I think it's been our policy to tell everyone at the same time when we send our quarterly letter. And we've got a lot of investors who are not on the list today. And so out of fairness, I think we shouldn't say anything until the quarterly letter.
Okay, no, perfect. Yeah, so one of the names that we've started buying is one that I used to know quite well, many, many years ago, but something happened in it that I didn't like and just thought, no, I don't want to touch this at all. And then, it turns out whilst I wasn't looking at it for over the course of several years, what I feared was going to happen happened. So when I revisit it, I go, hang on, this has all happened. All the bad things I thought were going to happen have happened. And I then have to sort of, turn my head around and go, no, this may no longer be a bad company because the bad stuff has happened. But that means that there's a lot more to do from my point of view. And this particular company, I think it's very difficult for me to say any more about it, just because of the nature of what's going on. But sorry, I thought someone was speaking there. So I'm pretty happy with what's going on for in terms of analysis. That we have a really good process, which I think is guiding us through this, and is meaning that I'm not losing my head. I remember 2008, and I remember the absolute dread of seeing stocks down 5-10% in any given day, and that was very hard, especially for a young man to deal with. Now in many ways, this is more frightening. It's I now see a stock down 10% and I cough.
So have we lost Aubrey? I think he said cough and then he disappeared. Well, Mark.
Yes, I'm sure Aubrey will. Aubrey's back. Aubrey,
you said cough and you disappeared. I got worried for a second. I think the connection on Aubrey's side
Yeah, it's connection is wavering a little bit here, but looks like we're back. But no, as I say, having this process is just such a boon. It has taken us through, knowing which companies to avoid, making sure that we have the valuations done in advance. We did a valuation on all the companies in our wish list just 2 weeks ago. So, I feel we're in a really good place to act as a responsible steward of capital through these challenging times.
I also want to add that one of the things that have happened that kind of helped us here is both Aubrey and I have been kind of worried about valuations for, well, probably 3 years now or so. And so we used to use this metaphor 2 or 3 years ago, and then we kept repeating it until the point that I think it was starting to get old, where we said we're kind of preparing for the flood and we're building the ark. But then the flood never came. So we've kind of been pessimistic and trying to figure out what are we going to do if the market declined by 15, 20%, 30%. What's our response? And we kind of were slowly working on that. And the fact that there weren't a lot of attractive opportunities for a very long time meant that we could work more slowly and diligently on our kind of longer term things we really want to buy. And I think at the end of 2008, when we had that very quick decline, that kind of forced us, and this is, again, luck is very important, but the fact that it happened, and it happened very quickly, it kind of forced us to kind of really press on and update those models in the list. And that decline was very short. So while we did end up actually going to fully invested, it didn't last for a very long time. So we started to build again from there. So the fact that it happened 2 years ago, I think, helped us in getting there. But again, I mean, we've said this many times. It's the time to be doing the homework is when the market is expensive. The time to prepare is when there are no opportunities. When there are opportunities, like these days, there is no time to prepare. There's time to act. You can update your models, you can stress test some of the things that you've done, but you have to act. You have to act with force, and you have to act quickly. Aubrey, do you have anything else to add, or should we go to Mark?
No, let's go to Mark.
Mark?
Yes, thank you, Aziz and Aubrey, for that update. As Aziz has mentioned, we have announced a special NAV. The rationale for that being that we are fortunate enough to have an investor base comprised of people with a similar view of investing philosophically to both Aziz and Aubrey, and who are happy to take that counter-cyclical, that contrarian view and put capital to work now. And over the last few days, a number of our existing investors and other potential clients are now making commitments to the fund. And those decisions have clearly been made on the movements in markets over the last couple of weeks. And at the moment, a week is a long time in the market. And we think that decision to invest in the Mayar fund should coincide with an earlier opening of the NAV. And so the NAV valuation date will be Monday, the 23rd of March, and the dealing date will be the 24th of March. The transfers into the account will be accepted for that special NAV. If you have any questions about that, if you want to know what the process is, please do not hesitate and get in touch with either Aziz or me. I'm on mark.cox@mayarcapital.com. So please feel free to contact me if you've got any questions about how to do that. And for those and really, I think we're, as Aziz noted yesterday, we're fortunate to have a number of investors who are, or an entire investor base who is aligned with the principles and the DNA that flows through the philosophy and the process of Mayar. I mean, I note that Aziz said, if I buy today and then open my eyes in 5 years, have I made an acceptable return given the amount of risk? That's the approach that we've taken, or Aziz has taken since 2011, and we continue to take through these more volatile times. And that is the rationale for the NAV. So if you have any questions, please get in touch with us. And in terms of questions, we did have a couple of questions come through earlier.
So Mark, just before we get into questions,
mm-hmm.
I just wanted to also reiterate what Mark said and what I said yesterday in my letter, that it brings me a lot of happiness, and I really have to thank you all. It brings me a lot of happiness, first because it means that we've been blessed and in selecting an investor base that is aligned with the way we think. And I mean, I've written about this a lot over the years, and how one of the biggest advantages that we can have, and I think that we have, is having an investor base that thinks like us in terms of time horizon, in terms of how we think about investment opportunities. And I think that's really been key and will always be key in our ability to actually succeed. And the level of response from all of our investors that have so far talked to us has just been unbelievable. I mean, I more or less, I mean, definitely in terms of a dollar amount, this is the largest dollar amount of commitments that we have received over the past several years that we have ever received in probably not only a month or a quarter, perhaps even a year. And so actually this year, in terms of new investments, is going to be an all-time high. And I think to have an investor base that can think counter-cyclically like that is just an amazing thing. And your trust and confidence in us means a lot to me and to the rest of the team. So thank you so much for that. I just wanted to say that before Mark gets into Q&A.
Yeah, and if I may, I'll, Aziz, so I see myself sometimes as a little conduit to how more mainstream and asset managers and their client base behaves, because as we know, Aziz is slightly unusual in the sense that Mayar is, and the predecessors, the only way that Aziz has been expressing his investment philosophy. But the reaction to the Mayar investor base has contrasted with investor bases that I've had at much bigger mainstream bulge bracket asset managers. And the result of that is that, you know, you can always say to clients, you know, this is a difficult time to go with the herd. And the ultimate outcome is that those clients nurse some losses and look back with regret to acting too quickly. And so to build a firm with a client base so in alignment with the philosophy and the DNA of Mayar is something that's really pleasing, because you know those investment time horizons do matter. So yeah, I'd reflect that as well before we move into questions. Now, yeah, go ahead. Sorry.
Yeah, just let's go about it the same way we do at our annual meeting, where we can get one question that was pre-sent and then one from people in attendance, just so you can give everyone a fair chance.
Yeah, okay. I will. I'll direct. We've only got a couple of pre-submitted questions, and Aubrey has touched on some of that. Maybe you'd expand on that. But the first question is for Aziz, and is about position sizing. We talk in our DDQ about the types of position size that we go into, but clearly when markets are moving in the way that have been over the last couple of days, how have you approached putting that capital to work in those names?
So I think part of position sizing, so we generally run a concentrated portfolio of 20 to 30 positions. Our top 10 are usually 5% of the portfolio. Part of position sizing is you can think of it as what's the maximum that you want to know, the minimum you want. But part of the reasons why you want to have a concentrated portfolio is that you're not going to have 100 good ideas at any moment in time. And so part of running a portfolio with a handful of names is that it allows you to concentrate your investments in the ideas that you like best, while keeping some kind of cap on size and to manage risk. In environments like these, however, often there are abundance of ideas. And so, and you'll see this when our numbers come up, but if you can find one idea a day instead of one idea a quarter, then it's okay to put 1% in it, A. And B, you may not necessarily own that idea for a very long time. And so over time, you're going to sell some of them and reallocate to some of the other smaller positions that you've built during this period. The other way to think about it is when you've got volatility as high as it is now, I think it makes sense to build a position slowly over time, even if you can build it quickly. So there are liquid names where we could have built a 2 or 3% position almost in the same day that we've been building in kind of 50 basis point increments over the past several days. So there's an issue of where you want to end in terms of position size, how the journey looks like. But then also in times like these, our portfolio will be wider and with a bigger number of names than usual. So while for most of the past couple of years, we've been kind of at the lower end and around 20 names, we're already above 30 right now. We're probably going to end up by the end of the quarter with kind of mid 30s, maybe even more. Because there are a lot of good opportunities. That being said, there's one element that also is critical in situations like these in terms of sizing, which is the risk profile can also change. And so you may want to have a smaller position because it is a riskier time for some or a lot of businesses than usual. So it's in kind of the interaction between these two that you have to draw the line.
Okay, thank you for that. We've got a question on text, I guess we can call that. There is a lot of talk these days that with the current QE, inflation will skyrocket and fiat currencies would fail, and we should heavily invest in cryptocurrencies due to their scarcity. What is your take on that?
What scarcity? I mean, seriously, there is no scarcity to cryptocurrency. There is scarcity to Bitcoin, but there is no scarcity to Bitcoin Plus or whatever it was. There's, you know, I remember, what do they call it? Fork, where they do a fork and all of a sudden you have a new Bitcoin type currency. No, I mean, look, I'm not going to pretend this is something I understand. You know, I don't understand cryptocurrencies, but I have a rough idea of currencies, and currencies they have one of the best network effects of all. You know, you think Visa and MasterCard or Facebook have good network effects? Currency has a brilliant network effect. I get paid in pound sterling. My bills are in pound sterling. My day-to-day costs are in pound sterling. Yeah. Now, that being said, you know, Mayar's revenues are in dollars. So it would be a lot easier for Aziz to pay me in dollars. But all my liabilities are in sterling. The rest of my life is in sterling. For me to swap from sterling to dollars is almost impossible. If it's impossible for me to swap from sterling to dollars, then how on earth am I going to swap to Bitcoin? You know, yeah, I'm sorry, not my thing, but I wouldn't.
I'm gonna go in and touch on something else, which is, let us say that the premise is right of the question, but not the solution. So let us say that so basically, let me rephrase the question as, given QE, would this lead to inflation skyrocketing? And what's going to happen if it does? And for better or worse, actually, it looks like some of the early reads on inflation the past few weeks do show that inflation is actually skyrocketing. Now, a lot of it is probably driven by the way the data is collected, and so it may not necessarily be actually going up. And there is the kind of the price gouging that's happening on Amazon that's kind of driving maybe some of that. And whenever you do have a concentrated demand attacking a limited supply, whether it's toilet paper or sanitizer or whatever, you could have higher prices. Now, governments are kind of interfering to kind of prevent that from happening, but there are limits, I guess, to how much. But I also do suspect that that's temporary, and it's not something that can go on for a very long period of time. Now, you have to weigh that against the huge deflationary pressure that's going to come from A, a recession, and B, the disappearance of demand for big swaths of the economy. And so I think the odds are, at least in the near term, that there's almost no amount of money that you could throw at this that would cause a massive upward movement in inflation for a persistent period of time. Famous last words, of course, but I suspect that, so the US, for example, just announced 1.2 trillion in dollars as a plan to kind of help the economy. The UK is doing about 330 billion if you include loans, and that's 15% of GDP. So that's a massive, massive stimulus. And I don't think that will necessarily cause persistent inflation on an ongoing basis. That being said, if it does, you obviously don't want to be in cash, which we don't like anyway. And you do want to be in businesses that have pricing power, that can pass on that inflation to consumers, so the customers over time. There's not a straight line, and if you did have a massive inflation, you're going to see a price correction in these names. But again, if we're looking on like a 5-year basis, if you own quality companies, they should be able to withstand inflationary pressures and generate returns in real terms. There's another question, it looks like. Mark, do you see it?
Yes, I see it. The current situation is closest to a world war. Schools and businesses closed, productivity halted, and governments referring to their actions as wartime policies. In light of all that and what was said earlier, how worried are you that the preemptive fiscal and monetary policies may not be enough? And if so, what then?
I don't think it's going to be enough. And I think there's going to be more of it. I think governments have learned a valuable lesson from the financial crisis, and that you need to act sooner, you need to act bigger. I think they still lack imagination, but I think they're already way more aggressive than they were in any downturn in the past. It's going to depend on how long this thing takes. This could all be over in 3 months' time, or at least most of it, and it could drag on for a lot longer. We simply do not know at this stage. But I think that governments have the ability. So let's actually unbundle this. You've got the fiscal response and you've got the monetary response. And then the monetary response is basically, is there enough liquidity so businesses can borrow and individuals can borrow to withstand this period? And I think that's probably easier because central banks have already thrown caution to the wind a long time ago in terms of being worried about growth in money supply or doing QE or whatever. And rates are so low that everybody's insane in terms of monetary instruments anyway. And you can do that much more easily. Central banks can do that much more easily because they can act quickly, you can act unilaterally, and there's less of a political machinery to it. On the fiscal side, I think is usually when things happen. And I always remember kind of when TARP failed to pass in Congress in 2008, and the market just crashed immediately, and then Congress came back together and passed it again. And I think there was a lesson learned there that you do need to act fiscally. I suspect again that on the UK part, a lot of it is loans, some tax holidays and so forth. The loans will help bridge the gap. They may not be enough as a fiscal stimulus. The budget has also come up with fiscal stimulus anyway. So we'll see. It's going to depend on how long, but I expect there's going to be more of it. And when you have things like the US government coming out and say, we're going to send $1,000 check to every adult in April, and if this drags longer, we're going to send them another $1,000 check in May. This was not talked about in the past. This shows me that you've got governments that are willing to go above and beyond what they've done in the past. And then the other thing that we're seeing now is there's a lot of coordination globally, whether on the monetary supply and the fiscal supply, to deal with this. So I suspect they're going to see more, but I think you do want to phase it in, because if you give everyone cash right now and they're just sitting at home doing nothing, there's really no point to it. So you do want to give enough stimulus so people can survive, and then ideally, if you could time it, like T-1 when this ends, you want to inject a lot more stimulus to help accelerate the recovery. By the way, if anyone wants to ask a question, they can unmute themselves and they can just ask a question if you don't want to type it.
Okay, if we'll give it some time to for people to do that. But while we're doing that, I just wanted to revisit something Aubrey mentioned before, which is relating to debt analysis and what role that has been playing in the research and the analysis that you've been doing over the last couple of days.
Sorry.
All right.
Again,
I don't like the coughing there.
Yeah, me too. Getting a little paranoid now. Okay, so as I say, the first thing is let's just look at what is the absolute debt level. Yeah, and we are talking financial debt here. We're not talking operating leases, but but that is a secondary point that we look at later. The first thing is just what is the financial debt? How much? What is the interest? What is when is it due, as I said earlier? But also, what are the covenants? You've really got to dig in. What are the banking covenants? I mean, because they vary from stock to stock. One that we own has a covenant of it has to be one times interest cover. Which is a really this is proper covenant light. Well, okay, I guess covenant light would have no covenants, but one times cover is pretty easy in this market where interest rates are very low. To have that, that's just not an issue for it. But there are others there which are, I've seen which are 3 times EBITDA, and that's a pretty standard one. Now that's not in our portfolio, but a lot of companies you see it, let's say 3 to 4 times EBITDA, and that can be that's a level that you can get to quite quickly. It doesn't take much revenue decline because, the second part of the test is to look at what's the operational leverage. If you have a business with, 50% gross margins and 10% operating margins, a small decline in revenue can lead to quite a large decline in, operating profit. It sort of magnifies itself by about 2 times in that scenario. So you there have to be quite careful, because all of a sudden, if you see a 50% decline in revenue, you wipe out all your profit. In some cases, go into loss, and so that's part of the stress testing. You take that, you then say, okay, so if revenue declines this much, you then breach your covenants, or if revenue declines this much and you're shut down for this long, how much debt are you accruing? So all these things that we're thinking about to try and really put these things through stress, as much stress testing as possible, because and the way the market has moved right now, I don't want to do this, but I bet you if I just went through S&P 500 and crossed off the names that I think are most vulnerable, and whatever's left, I think is a portfolio that would do really, really well. Yeah. Now, we hope that we can do better by also figuring businesses that are really good as well.
Nobody stop giving ideas to people.
Yeah. Well, I tell you what, if you can go through every stock in the FTSE or S&P 500 and really do that sort of level of analysis, I mean, because it's it's hard work. It's you stay up quite late at night doing this. It's also fun, but well, that's just we like our job. But yeah, no, I think the long and short of it is we just really have to stress test everything really thoroughly, because if we can avoid explosions and really big mistakes, which, touch wood, I hope we do for the most part, then I'm pretty confident that 5 years from now we'll be very pleased and very glad we had all those late nights.
Okay, thank you, Aubrey. I don't think we've had any questions come in.
There's nothing typed. I wonder if
I haven't seen
I'm not on the other end, so I don't know how easy it is for people to unmute themselves. If anyone in attendance can please unmute themselves and give it a try, at least so we know that it's working.
Hi, Aziz. It's Sophie.
Okay, good. So we know it works. Okay.
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 Well, I think in the absence of any more questions now, we'll probably leave that there. We've been going just over an hour as well. So I'll hand across to Aziz for any closing comments. But please, if you do have any questions that occur to you afterwards at any time, please feel free to contact us. Our door is always open, especially in these types of environments. But for now, I think we'll leave that there, and I'll hand back over to Aziz.
Yeah, so what I want to say is, first and foremost, I think I want you all to be safe. So do wash your hands for 20 seconds, several times a day. This seems to be the best thing you could do. The other thing is, I want to share with you something that I did very recently, which is on Sunday night, I sent a message to all the WhatsApp groups that I was a member of. And I said, I'm terribly sorry. I'm taking a digital self-isolation until further notice. And I left all the WhatsApp groups, and then I left all the social media accounts that I use. So no Twitter, no Instagram, no Facebook. And I cannot stress to you how much better I feel today. I mean, the first day didn't make a difference. I was feeling a little bit better yesterday. And today I'm feeling great. And what I did is I subscribed to, in my case, because I live here, to the UK government's official email for notification to citizens and employees, and employers, so that I can get information from the government that I know that I can trust without sensationalism. And I get about, I think, 2 emails a day from them. And all I need to know is something like Monday, where they said, you know what, from now on, you should work from home. And I got that email and I started working from home. But it's this constant stream of WhatsApp messages and a lot of fake news, to be honest, on both WhatsApp and Twitter and all of that can cause a lot of stress and anxiety. And as we spend the next several weeks at home in closed environments, I think it's very critical for our mental health to try to manage that part. There are things that we have to do, and we need to find a source that we trust that can tell us what is it that we need to know to deal with this situation. But I highly recommend kind of disconnecting from this barrage of information, this fire hose of a combination of both real and fake news that I think does nothing but kind of cause us anxiety and cause us to freak out. If we're going to have to deal with this for a very long time, we have to be more level-headed and more emotionally strong to be able to survive it. And that's my recommendation to you. In terms of what is it that we plan to do on the NAV side, so like Mark mentioned earlier, we are opening up a special NAV on Monday. That means if you transfer money between now and Monday, it'll go into the fund on Tuesday morning. We will still have the normal NAV and dealing date at the end of the month. So essentially, there's going to be one in a few days and one a week after that. So depending on how things go on your end, if you do want to subscribe, this gives you 2 opportunities to subscribe. In April, we're still planning to have the normal once a month. However, given circumstances, if enough of you want to come in kind of mid-month in April, we're gonna do a special NAV in mid-April to accommodate people. And I think that's thank you so much for attending today. I hope you like this format. It's the first time that we've done it. Luckily, it seems that the technology is working, which is great. And maybe we explore this further in the future and do more of this where instead of just the one annual meeting a day, maybe we can have another investor event at another point in the day. As Mark said, I remain available. The rest of the team is available to answer your questions and help you in any way that we can. Thank you once again for attending. Thank you for your continuous support and trust and everything that you do that allows us to be stewards of your capital. Wait, I see one chat message coming through. Okay, that's fine. All right, thank you all.
I'd like to say one thing.
Sure.
Very, very impressive. Your investors are extremely lucky to have you managing their money for them.
Oh, thank you, Dominic, so much. That's very kind of you.
Dominic, such a well-considered approach to what you're trying to do for them. Well done, you.
Oh, thank you, Dominic. By the way, Dominic Fisher is a dear friend and a great fund manager in his own right. And
yeah, not quite as great as you, because my fund is going down like a stone at the moment. I can tell you.
Well, it just means it's an even better opportunity to buy your fund.
Anyway, well done, you. Bye-bye.
Thank you. Thank you all. Take care. Have a good day. Bye-bye.